Welcome to chapter 22. So we'll get started. The main objective today is to understand the classification of the statement of cash flow. I thought my pen would work right away. There we go. So classification. So we'll describe the purpose, the uses of the statement of cash flow. The uses is mostly for analysis and decision-making by users of the financial statements, including the statement of cash flows. We're going to focus on the classification. There's three. It's not a difficult chapter. It's also not a long chapter, so we'll get through this fairly quickly. It's fairly straightforward. You have studied this before in Intro Accounting 2 and in Intermediate Accounting 1. You would have seen to some extent the statement of cash flow. So it's not really new. The challenge is some students find it difficult because of the indirect versus direct method for presenting the operating activities. Okay, I'm saying it's not that bad. It's actually a pretty easy chapter, and we'll get through that classification in a minute. I'll go through a few examples of the basic steps of a manual preparation of statement of cash flows. But in most businesses, the statement of cash flow is automated either through Excel, Caseware, some software. It's automated. So once you get it down, it balances. You know the answer of the cash flow statement. The answer is ending cash flow, ending cash balance, cash and cash equivalents. So it's like you already know the answer. You just have to figure out how to classify the cash receipts and the cash payments to the three different categories. And then there it is. There's your cash flow statement. So it's not super hard. Theoretically, sometimes it can be confusing when we get into the weeds. But it's, a lot of it's automated, so I wouldn't worry too much about it. And it's not really evaluated that much, the preparation in your professional exams, right? And in your work, it's automated. So I'm not too worried about the manual preparation. What is important from the cash flow is how to analyze a cash flow statement for decision-making purposes. So in your professional exam, you'll be given a cash flow statement already prepared, and it'll say, okay, tell me what you think about the company. Are they doing well, not well? Where are they investing? Where are they obtaining their financing? Do you think they're doing well? Is there room for improvement? That analysis and decision-making around cash flow, that's important, okay? But it's normally based on a cash flow that's already prepared. For this course, we still need to understand the mechanics of that. So we'll get into that. And then some disclosure. The interpretation, I will cover that later on. Cash flows is important, right? They say that cash is king, okay? I'll draw a crown. This is my crown. Yeesh. You can let me know if you think that I should become an artist instead of an accounting prof. So cash flows is really important because if you don't have enough of it, you can go insolvent or bankrupt. So this is something that needs to be monitored carefully, and companies will monitor their cash flow weekly, monthly, quarterly, and annually, and even over a number of years to see and prepare projections to see where they think their cash is coming in, where they need to do investments, and where they might be able to obtain financing for those investments. At the end of the day, a for-profit company, a for-profit organization, it's important that they have eventually positive cash flow from operations. We'll get to one of those classifications later. Because of the yin and yang effect and the errors that I covered in chapter 21, errors always end up reversing, right? You can only hide errors for so long. If you hide an error 1 year, the next year you have to double up the error in order to hide it, because otherwise it wants to reverse, okay? Automatically, it's the yin and yang accounting effect. So eventually your cash flow from operations should be relatively close to net income, okay? So you can only hide so much and falsify net income so much until it starts not working with your operations, right? So while net income can be manipulated only for so long, it's actually really hard to manipulate cash flow from operations, right? Because it's cash in, cash out, and it should correlate over a few years. It should correlate with net income. If net income is down 70%, you would estimate that cash flows from operations should be down by approximately 70% as well. And the opposite is true. If net income is all of a sudden double, you would expect cash flow from operations to be double as well. Otherwise, there's red flags of manipulation. Now, if you don't have, this is the interesting about cash flow. If you don't have cash flow, suppliers won't extend credit, okay? So you need to demonstrate that you're able to generate your own operating cash flows. In that situation, you demonstrate profitability, then suppliers are willing to extend credit so you can purchase goods and services on credit, pay them in 30 to 60 days. Otherwise, you have to finance that yourself, pay cash, and that becomes expensive because now you need to borrow more. And then borrowers won't extend larger amounts of credit until you're profitable yourself. Or if they have loans extended, there might be provisions in the loan agreement where the lender may be able to call a loan if it believes the company is going towards bankruptcy, and that would precipitate a cash flow crisis leading to bankruptcy. So cash flow from operations, positive long-term cash flow from operations is quite important, right? So we want to analyze it, measure it, predict in the future, put pieces in place to reassure suppliers and lenders. So the statement of cash flow is used to assess the quality of earnings. What this means is it's a ratio, okay, where I forget if it's the numerator or the denominator. It doesn't really matter, but it's, say, net income divided by cash flow from operations. Okay? It's just a ratio. And if I give you that the ratio is 85%, and then I ask you, is that good or bad? You would say, well, it depends, right? Everything's relative. It's over time. Say if I compare this 85 with last year, which was 115%, well, we'd say, whoa, that's not, there's a big difference, right? And yes, it reverts, but a big swing in 1 year after the other would be maybe an issue to maybe investigate. So the quality of earnings, what we're looking at is manipulations in the net income. And I forget if the net income is the numerator or the denominator, but it's those two elements, and we want them to be close. Otherwise, we worry about the quality of the earnings in terms of manipulation. Okay. Next, we use it to assess the company's ability to repay debt from its cash flow from operations, and self-generate cash to pay dividends, to reinvest in the company. And the self-generation is the operations, cash flow from operations. The primary purpose of the statement of cash flow is to provide information about cash receipts, cash payments. So we have a cash balance at the beginning, and we have a cash balance at the end. And we want to know in between, where did the money go? And we do that through the cash receipts, money that came in, cash that came out, cash that went out, into 3 categories. We'll get to those 3 categories in a minute. Oh, they're right here. So those categories are operating. That's the first one. The second is investing. And the third one is financing activities. Cash flows, okay? So we have in our statement of cash flows, we'll have operating, we'll have investing, we'll have financing, okay? And then we'll have the change plus beginning balance of cash, okay? And then that'll give us our ending balance of cash, okay? Well, what is the ending? What is the beginning balance? What is cash? So cash is defined as cash and demand deposits, okay, that are readily available. But also, we also allow cash equivalents, which are investments, but they're highly liquid. So GICs, something that can be converted into cash really quickly. We say about less than 3 months, less than 1 quarter. And they can be used to get the company out of a bind if necessary. So we do include them as part of cash. If they weren't included as cash, they would be investments included in investing activities. So like I said, we have operating activities, we have investing activities, and we have financing activities. Operating activities are current assets and current liabilities. Investing activities are non-current assets. Financing activities are non-current liabilities and equity. Okay, in terms of assets equals liability plus equity. Anything current here goes operating, non-current goes down, and all of equity goes to financing activities. Yeah, except retained earnings, part of retained earnings, not the dividends part, but the net income part is part of operating activities. So equity down here would be changes in share capital. If you're lost, it's fine. Okay, it's not that complicated. I'm just probably going a little fast, and you want to go over it again, or read the textbook quickly, or slowly, and it'll come together. It's not that complicated. So we want to know the change in the cash balance between in the statement of financial position, that's the balance sheet, in the cash account, between the cash beginning and cash ending. Where did the cash go? Where did it come from? This is what we want to answer with the cash flow statement. Let me, hold on, I'm going to close this, ignore all this. I'm going to create a new slide. Let me draw you a picture. So I'm gonna jazz it up here, changing colors. Let's go with maybe I'll start with this, whatever that color is, maroon, red, dark red. Okay, so what are our 3 main financial statements? Are these rectangles? No, they are financial statements. So we have our balance sheet, we have our income statement, and then we have our statement of cash flow. Okay, how do they correlate together? Obviously, we want to explain the cash account. So we want to explain the change in this cash account here. So this would be the cash account. And the line in the middle that I drew is the difference between my debits and my credits. So debits, credits. And the statement of cash flow doesn't have that concept because we're not working with journal entries. We're simply reconciling a balance in 3 sections. So we have our operating activities, we have our investing activities, and our financing activities. Okay, so if I change color, let's explain the link of what I said in the previous slide, but let's do it visually now. So let's start with yellow. So operating activities is all yellow. Where does it come from, right? Well, I could draw a line right here, and the distinction here would be the difference between current, okay? So this would be current. I'm already regretting choosing yellow. It's not the best color. Current assets and liabilities. So all current assets and liabilities, okay, accounts payable, accounts receivable, prepaids, those are all transactions that come from elements within my income statement, right? So accounts payable come from purchases, right? That get consumed or used in my activities, my operating activities. So they're expenses, debits on my income statement. Accounts receivable come from sales, which are credits in my income statement. So all of the income statement, both debits and credits, go into the operating activities. And it's only the elements that have cash elements. So my depreciation expense, amortization, that doesn't have an impact on cash. So that would get eliminated from my operating activities in my statement of cash flow. Okay, so yeah, yellow goes to operating activities. Next, let me pick a better color. Oh, green. Green's always a good one. Okay, so then the next one is my investing activities. Okay, where does that come from? It comes from my non-current assets. Non-current assets. This might be my investments, could be property, plant, and equipment, my intangibles, intangible assets. Those are all investing activities. We wanna separate them out from operating activities because they're long-term, right? We use these to generate profit, right? But it's not part of, they're not directly related to the actual sales. Okay, so whenever we purchase, the cost is a reduction in the investing activity. So while a purchase will increase the balance sheet, right? We have debit cash, debit investment, debit PPE, property, plant, equipment, but we would have a credit to cash, and that credit to cash should reduce my cash balance. So it acts as a negative in my investment section of my statement of cash flow. And then finally, no surprise, financing activities. What do I have here? Blue would be good. So financing activities, last one. And then that would be non-current liabilities and equity. Okay. The retained earnings portion, okay, that would be part of the income statement. So there'd be a little bit of yellow here, but that is through the net income. And dividends, we'll get to that in a second. There's actually an option. There's an option to present dividends either as part of operating activities or financing activities. We'll get to that in a minute. So all this non-current assets, anything financing for the purchase of investments. So normally, if cash comes in, cash goes out in investment. We use the cash that comes in from financing activities to pay for our investments, right? Now, if I happen to sell investments, okay, normally that's a company that is de-investing or declining, and they would be selling investments, gaining cash from that to repay any finance like long-term debt or share repurchase. And that would be part of financing activities, but it'd be a negative because we're paying back. Yes. So where do we get the numbers? We normally get it between two periods. So we look at the balance sheet. Let me go back to red. So don't confuse anyone. Go back to red. So we normally have the balance sheet 2 years. So we'll have, we'll have 2023, 2022. So we look at the difference in, say, the investment account, and we look at the difference here if it goes up or down. And if it goes up, that means we purchased investments, and then that would be, that would be reflected in the statement of cash flow. So we're normally using the balance sheet over 2 years, comparing that change and figuring out if it has a cash effect or not. Okay, so some things don't, like depreciation expense, bad debt expense, those wouldn't have a cash effect. Yes, okay, so let's get into the details. What color am I on now? Regular red. Oops. So cash flow from operating activities are receipts from customers or payments to suppliers. Think current assets and liabilities. Yeah, so the inflows, the outflows. Now there's two methods. This is where students get confused, or they get stressed out that there's two methods for calculating operating activities. Investing activities always, and financing activities always uses the direct method. Okay, it always uses the direct method. But for operating activities, we are able to use the indirect method, which is starting from net income and then adjusting for every non-cash items. Okay. When you do the homework, it'll look complicated, but it's really not that bad. They give you the same answer. It's just two different ways of presenting it. Okay. You'll need to learn both, but they're really not too bad. Okay, so don't stress too much about it. You'll get there. Just do the homework, practice it. After a little bit, you'll get it. So under the indirect method, the net income is the starting point. And then we adjust for any non-cash items, and then we end up with cash-based income, which is equal to our cash flow from operations. That's kind of what we want to show is, okay, what's net income, but what are all the cash elements, right? It avoids that manipulation, and it's that quality earnings thing. Is there a big difference or not? You can make a lot of sales, but if you made a lot of sales on credit, but you never collect it, that's problematic, because it basically, if you're never collecting, you're just giving away stuff for free. Now, investing activities are the acquisition and disposal of non-current assets. So think property, plant, and equipment, investments. Okay, and then financing activities are receipts and payments. Okay, in the entity's capital structure, right? Which is either borrowing or investing from shareholders, right? Which would be part of equity. So debt. Leases as well. We studied leases a little bit earlier, and share, the issuance or the repurchase of shares. Okay. So this is one of those complexities in the chapter, because the standards are a little bit complex here, the accounting standards. But I'm going to show you a little quick secret, a little trick. Okay. So I'll explain the rules first, and I'll tell you my trick. So in investing and financing activities, okay, there are classification choices, okay, between dividends and interest. Okay, and the water gets muddy, because if I show you my diagram, okay, dividends and interest are very similar. Dividends get paid on to shareholders, right? It's their return on investments. But interest is paid on lenders, and the interest is their return on investments. So they're really similar, okay? Really similar. But for financial reporting purposes, interest, we consider it part of an expense in the income statement. Where dividends, we say, no, they're not part of the income statement. They're part of retained earnings, right? So they're different, but for accounting purposes, they're different. But from a practical perspective, if I'm the company, I can choose to either borrow money or get money from shareholders, and I'm paying a cost either way. I'm either paying dividends or interest. So it's the same. And there's plus and minuses to both, right? It's part of financial leverage. Okay. So because of this muddiness in the water, it's not clear, it's not black and white, there are choices. Okay. So the dividends, okay, are part of the shares, and the shares are part of financing activities, right? We determine that, right? So the dividends paid can be part of financing activities, and the interest, right, is part of the income statement, so it's part of operating activities. So now we have dividends paid as part of financing activities and interest paid as part of operating activities. So now we just established that they're similar, but now we're presenting them differently. Okay, so if I go back now, the IFRS and ACCT have gotten together and have determined that there's choices. Okay, so interest and dividends, okay, paid, which is the example I was saying, can be recognized in one or the other. They can be recognized in either operating or financing. Okay, it can be. Okay, so operating or financing. Now, if I receive interest and dividends, right? So if I receive now, well, if I receive it, it's part of income, right? Income, it's revenue from interest, dividend revenue, right? But the vehicle that gave me that revenue is part of investments. I have investments, it gives me a return. Those investments are part of investing activities. So we also get the choice for anything received to record it as part of operating or investing, okay? These are decisions that the companies make based on the sector of activity. So if one company in one sector, like grocery stores or retail, they're presenting it this way, and all their other competitors are presenting it this way, they tend to do it the same way because they have the same users, investors that are interested in that sector. Okay, and for comparing apples with apples, it makes sense that everyone in the same sector presents it in the same way. So here's my secret, is that in all options, okay, operating is always an option, right? So interest and dividend paid or interest and dividend received just a second. Okay, operating is always a choice. So the easiest thing for you for exam purposes in this course and your professional exam is just choose operating activities for purposes of learning, knowing that in real life, financing and investing activities are also a possibility, okay? And depending on the sector of activity, is being done, okay? So just keep that in mind. For this course, just use operating activities. It's an easy trick, and that way you can't get it wrong, right? Because if you were to record interest and dividend paid as part of investing activities, that would be wrong, right? And then you would get it wrong, you get a wrong answer. So just put it as part of operating activities. It's easier that way. Yes, okay. So here's some of the nitty gritty. We're getting into the details. So investing and financing activities report on the income statement. What's reported on the income statement is the gain or loss, right? So we have, say, an investment. It was recorded at, we purchased it at $1 million. We sold it at $1.3 million, right? But we want to derecognize this and bring it to zero. It's gone. We sold it. So we need to derecognize 1 million, nothing more. Where does the difference go? The difference goes to gain, right? And my cash goes up 1.3 million. What would be the journal entry? it'd be dividend cash, credit investment, and then credit gain, right? Cash would be 1.3. Here, the investment would be 1.0, and the gain would be 0.3. Okay. So what goes to the income statement is only this. When I prepare my statement of cash flow, I need to back this out, the gain. It's a non-cash item. What's included is the cash. The full 1.3 is included in investing activities as a cash receipt. Okay, so the gain or the loss is a non-cash item that gets excluded from operating activities. Okay, the full 1.3 goes to investing because it's a sale related to an investment. This is how we've decided to categorize it. Same thing with debt. Okay, if cash is paid to redeem a debt, but it results in a gain or loss, the gain or loss is excluded from the operating activities as a non-cash item, and we include the full payment as part of financing activities. Outflows to purchase investments are investing activities. Nothing surprising there. What are other things that are non-cash items? So the statement of cash flow reports only the cash effect. Examples include the acquisition of assets by assuming a related liability, okay? But they have to be really, really like the same transaction, no exchange of cash. If it's an exchange of cash, then what I would see is I would see a reduction in investment for the payment and an increase in the liability from getting new debt, okay? So I would see a minus and a plus, okay? If it's the same transaction, it can be excluded from the cash flow, okay? But it has to really be non-monetary transaction. Same thing, if I exchange an asset, so say I exchanged a building for another building with another company and it's non-monetary, I could exclude it from my cash flow statement, or the conversion of convertible debt or preferred shares into common shares. Those obviously, because of the conversion, they would be non-cash and excluded from the cash flow statement. In terms of format, we always present the operating activities first, then usually investing. Sometimes it's flipped. Sometimes it's financing, then investing. Usually it's investing, then financing. The goal is to provide a reconciliation between the beginning balance and the ending balance. And then for operating activities, we have the indirect method or the direct method. Indirect method starts with net income and then adjusts for any non-cash items, where the direct method, we'll get to it, looks at all the cash receipts from sales plus minus for the change in accounts receivable. And it does that by looking at the balance sheet, okay, of say 2024 and comparing it to 2025. We'll get to an example. The indirect method, okay, so this is kind of what it looks like conceptually. We start with our net income here. We adjust for any non-cash items, plus minus. We finish with our operating activities. Cash flows from investing, we have our plus minus any activities, plus minus for financing activities. We get our change plus our beginning balance here gives us our ending balance, and this should balance with the balance sheet at the end of the year. It has to, mathematically. There's no option. It has to balance with the cash and cash equivalent balance on the balance sheet. What's funny, okay? What's funny is that IFRS and ASPE in the standards encourage but don't require the direct method. but most companies use the indirect method. Why? Because everyone knows the net income, right? So you start with net income and then you just adjust for non-cash. So it just simplifies the presentation. Whereas the direct method, you have more line items for the different cash flow. It does provide, I guess, more information, but not to the point where users of the financial statements have lobbied hard enough to change the standards to require companies to use the direct method. The standards are in place to protect users of the financial statements. They exist for the users. So if IFRS and ASPE haven't mandated the direct method, it's because users don't really care that much in general. Okay, so this thing where they encourage it, but most companies, I think it's kind of silly. I think it's probably because the direct method doesn't really give that much more information for users. So the direct method, okay, so whereas here I would start with net income and I would have a few adjustments for non-cash, under the direct method, I have cash receipts, cash payments, and I finish with the same amount, right? The same amount here would be the same amount here under the indirect method. So it's just a presentation that differs, but the total is the same. How do we prepare a statement of cash flow? We'll compare the balance sheet, okay? We'll compare the accounts receivable balance in year 2024. We'll see the the AR balance for 2025. We do one minus the other and it gives us a change. And then we adjust our cash flow for this change. So let's look at an example using the direct method. So we have tax consultants began operations in 2022, issued 20,000 common shares for $20,000. Office space and furniture were rented. Revenue came from tax consulting services. And we have comparative statements for 2023. So we have our net income here, okay? And then we have comparative balance sheet. So we don't need comparative income statement, but when preparing a statement of cash flow, we do always need comparative balance sheets or statement of financial position. Okay, this is what we're trying to get to. We're trying to explain this difference of 49,000. Accounts receivable, they went up, right? So I had sales here. I would assume that I received 125,000 in cash from my sales, but my accounts receivable were up 36,000, meaning I didn't collect 125. I collected $36,000 less. Okay, so that'd be what, 89,000, I think, right? So I collected, the difference is I collected $36,000 less. The other way to see it is, let's do the journal entry. Here, what would be the journal entry when I collect? I remember when I was a student, I have trouble conceptualizing it, because I would say, well, what if not everyone in 2022 paid the 30,000? How do I know if the full 30,000 was paid? It doesn't matter. Because if it wasn't paid, it'll get reflected in the $66,000 anyways. So we're really only interested in the difference, okay? We don't need to know who paid and who didn't pay. Okay, we assume everyone here paid. So what's the journal entry? Well, we debit cash and we credit AR. So my cash is up by 30,000. But what's the journal entry here? It's debit AR, credit sales. No cash. Right? So if it's part of sales revenue and it's part of the 125, but I didn't get it, I want to add this back, or like reduce my cash receipts from customers because I didn't get the 66. I did get the 30,000 from last year, right? So I got this. So that's a plus. This is a minus. And the difference is 36. So another way to look at it is 125 plus 30. Sorry, where am I? 125 plus 30 here minus, what did I say? 866 gives me my 89. Okay, you could conceptualize it as you're learning. You could conceptualize it either way. You can look just at the change, but if you're like, I still don't get it, then look at it balance by balance. You get this, or you pay it when we look at liabilities down here, or you didn't get it. Okay. Depending if we're talking about accounts receivable or accounts payable. Okay, and then accounts payable, same idea, but it's like the flip side, right? So here I paid this, I didn't pay this. There's an increase. So that means in my expenses of 85, right here, 85, I'm assuming I paid this, except I paid 85 plus 30, which was my expenses of last year, but I paid them this year, plus 30,000, minus I didn't pay 35. That's good. I paid less. This is good for my cash flow. So minus 35. So what I actually paid, it was only 80. That's minus. I only paid 80. I only got 89 in actual revenue, but I only paid 80 in actual expenses. And then common shares, this we ignore, okay? We ignore because that's part of net income, right? My net income, 20 plus 34 should equal 54, except I have 40. So 20,000 plus 34, okay, is 54, minus the 40. Interesting. The difference is 14. What would this represent? That's my dividends. Okay. And then common shares is part of my financing activities. I know I'm jumping around everywhere. Okay. You can hit pause, you can back up and go through this again. I skipped common shares. I went to retained earnings. I was excited. And then I went back to common shares, which is part of financing activities. I think what I just did, much of it, okay, is here. Okay, so you have it line by line direct method. Okay, so we'll go through it. So now cash receipts from customers, right? We don't start with net income because we're using the direct method. We start with cash receipts, which is I draw this from my income statement. I adjust for the change between two balance sheet dates. Okay, so that's that 36 here. Okay, gives me the 89. I had already calculated that for us. And then cash payments to supplier is 80. Cash taxes paid, that's an easy one. It's given right here. Okay, no changes to make here. 89, 86 gives us a change to cash balance for operating activities. The total is 3,000. In our very simple example of 22.1, which is in the book, we see no investing activities. Financing activities, we had the issuance of shares, which was here. It went from 20 to 80. So we issued $60,000 in shares. And then the dividends that I calculated down here, dividends were 14. That's tricky because you would need to know that it's retained earnings beginning balance plus net income minus dividends equals retained earnings ending. So you need to isolate dividends, which I did here, to figure out the amount. And you got to ignore this 20, okay? That's not part of it. Because a portion of that is net income, which is already factored in my operating activities. There is an option, dividends paid could have been part of operating activities. That is what I recommend. In the example, they presented it as financing activities, fine. But for learning purposes, to keep it simple, I would present all dividends and interest received or paid as part of operating activities. Keeps it simple. Okay, So we covered that. You could look at the references here for further explanations, but I think I nailed it. And yeah, so that would be D. I covered that. And then the difference is 3,000 plus 46 equals a change, okay, which is an increase, could also be a decrease in some years, of 49. Okay, that's our change. And I think here's our change, 49 right here, 49. Our opening balance, so that's plus our opening balance, so 49 plus 40 gives us our ending balance of 89, which I think we saw that here. Boom, we just did a very simple cash flow statement. Looks like, and in real life, all this would be done, say, in Excel or Caseware and automated. And the auditor would simply make sure that this balances with the actual cash balance in the balance sheet. Here's a more complicated one, a little bit more detail. As we can see, we have the statement of income. We're going to be doing the indirect method. Okay, this one is more complicated, not because it's the indirect method. It's more complicated because we're working with more ingredients. It's a spicier recipe, right? We were working with 22.1 the last time. Now we're on 22.2. Okay, so it's a fully new case. So we've got more ingredients, more detail. We have our net income here. We're going to start with this because we're using the indirect method. We're going to adjust for any non-cash items. And then we have our dividends. So that's given. We don't need to calculate it. It's already given. We finish with our retained earnings at the end. And then this is irrelevant. We don't need to do anything with that. So we have our balance sheet, statement of financial position, or balance sheet, okay, for both years. We're looking at the change, okay? You need to figure out, okay, this change, you can do this calculation easily, but you need to figure out, okay, does that change result in cash receipts going up, cash receipts going down? Vis-a-vis the income statement, or the other two financing and investing activities, or cash payments, does that go up or down, right? So that'll take some time, some practice to figure out what is the impact. And if you get it wrong, then when you do, like if I go back to the previous example, if I get here and I did something wrong, like I don't know, I did a plus dividends instead, right? Well, I would be off, right? Because then that'll give me 74,000. I'll be off by 28,000, right? I'll be off 28,000. I'll get 49 plus 28, whatever that gives, plus the 40. This will be in the $100,000 range, right? Then if I do, okay, I got 110 minus 89, which you know what the answer is. It's your cash balance. And then if you take that difference, whatever that error is, divide by 2, it'll give you the 14. And you'll be like, oh, maybe my error is that I have the wrong sign. And you think about it, you think of the theory that you've learned, you adjust it, and you should be able to balance it. So if you only have one error, it's actually pretty easy to find it, because you take the difference, divide by 2, should give you the error, because you flip the sign. If you have multiple errors, then that doesn't really work, but there's a little trick for you. Okay, so I think we're starting with our operating activity. So we start with our net income, which is 59,900. We have a decrease in the accounts receivable. So that's good. That means that it's a plus 10,000 because we received the full 56 for sales from last year. And now our accounts receivable is down to 46, which we didn't get. So it's plus 56 minus 46, or plus 10, however you want to do it. And that gives me this amount here, plus 10. Inventory is up. I would have paid for that. So that's downward pressure on my cash flows. Decrease in prepaid, something I paid last year, it decreases. So that's, it goes in my income statement as an expense this year, the prepaids from last year, but they were paid last year. So that's increases my cash flow because I have in my income statement, in my cost of goods sold or some other expense, I would have had the prepaids from last year would have been included here, but I have 1,500 of non-cash items, which is here. Depreciation, always non-cash. Obviously, the cash impact is the initial investment in buildings and equipment in the year they were purchased, and that's part of investing activities. So these increase my cash. Increase in accounts payable, that helps my cash balance as well. Increase in income tax payable, so that would have been an expense here, income tax expense, of which 3,000 is non-cash. And then I paid $700 more in accounts payable last year than this year. That would be downward pressure on my cash balance. And you could, see all these references if you want, but I kind of went through them. That's operating activities. So I finished with operating activities of 90,600. I think now we go to investing activities. It's always the direct method. So this is, you could ignore that. I purchased land, which is land increased by 70,000. So part of that is land, 70. And then buildings here, 200. So that would be, 70 plus 200 for buildings. That would give me a negative, because I would have paid for it for land and building, and I purchased equipment for 5. Let's see, equipment goes from 63 to 68. So that's an increase of 5. Now, be careful when you do your homework. Buildings and accumulated depreciation might be together. You need to back out accumulated depreciation, because if you include it together, the change will have the accumulated depreciation, which you don't want because it's a non-cash item. You want only the building account. Same thing with equipment or any depreciable assets. Make sure you don't include in your calculation of increase decrease the accumulated depreciation. If I were to include these together, I get a false number and then I'm not going to balance out. So that's purchases, okay, covered that. And then we move to financing activities. We have a new mortgage payable that increases my cash. I paid some of this mortgage, 2,000. I issued bonds. I issued shares. I paid dividends, okay? This could be part of operating activities. That's what I would do. As I've suggested before, dividends paid and received, interest paid and received, put it in your homework, put as part of operating activities. Or not, but I suggest it's just easier. Okay, so that covers it. And then we put it all together in the presentation. We start with our net income. We add back non-cash expenses, depreciation. Depreciation always added back, is always non-cash. The initial investment is part of investing activities. And then we change for the changes in working capital is another word for current assets and liabilities. So I looked at these changes, which if I look at my balance sheet, it would be all this, okay? This is my current, and then this as well up to here. So all this is my current liabilities, current assets, obviously not cash. Cash is the total. So I've got 1, 2, 3, 4, 5, 6 items. And here I've got 1, 2, 3, 4, 5, 6. So I believe they're all there. Quickly, I've got 6 on the balance sheet, items, accounts, and I've got 6 accounts here. So I think that works out. Gives me the 90,600. We had already calculated that here, 90,600. I've got my investing activities. That's negative cash. And then I've got my financing activities here. I've got a total of 162. That's this amount, 162,400. If I do 90 minus 275 plus 162, gives me a total of decrease to cash, negative 22,000, plus my beginning balance of 59. I end up with an ending balance of 37. So because it balances with my cash balance, I put 2 lines underneath. It's the accountant way of saying it balances. I've checked it, it works. Here's my balance, 37,000, 37,000. So that works. Excellent stuff. There's no like, if you're like, I'm a little confused. Well, there's no secret recipe. You have to do the homework. Look at the other more detailed examples in the textbook. Review some of this example that I've done with you on this recording, and it'll come together, right? Reflect on how it works, where the plus minuses go, and you'll get it. Okay, it's just putting in the elbow grease, the time, and it'll come together. In terms of disclosure requirements, IFRS and ACCT have similar disclosure requirements. We have to explain what is included in cash and cash equivalents. We have to explain any non-cash significant investments that would not be shown in the statement of cash flow. There was a slide, we discussed that earlier. If I have a new investment that was financed directly, like a lease, then that would be non-cash. Well, in the notes, I have to mention it if it's significant. I have to explain what is part of cash and cash equivalents. And I have to mention that if there's any restrictions on cash and cash equivalents, like, oh yeah, I have cash equivalents, but they're restricted to 6 months where I can turn the cash equivalent into cash. Users would want to know that, because if I get into any financial issues, I have to wait 6 months instead of the usual, let's say, 3 months. The whole point of the statement of cash flow is to help predict the future. Where are cash flows headed in the future? Where is the company going? So if my investment section, okay, this I can see the company is investing by borrowing funds, right? It's a good story. I could see this story through the statement of cash flow. But if my investing activities are good, like I've sold stuff, I got cash for it, that paints a different picture. That means it's a company that's divesting, not investing. That's a different company, different story. If my operating activities are negative and I'm divesting, then that's a different story. And that's what I want to know through the statement of cash flow. So I want to answer, where did the cash come from? Where was it used? Did it come from operating activities? Did it come from financing activities? What was it used for? What did we do with that cash? The objective is to assess for operating activities if cash flow levels are sustainable and likely to be repeated in the future, right? We're always looking, what does it tell me? How can I predict the future, right? Obviously, we can do forecasting. It's not perfect, but it helps us plan and determine if we need to do anything now to avoid issues in the future. And we also want to see, like, are there any payments that were deferred? Or do we have any big cash payments to make in the future that is going to make us sad? Or are there any one-time events that are not to be repeated? So, okay, get rid of those. What does the future look like in a sustainable fashion? Or like, is it sustainable? Our cash from operating activities that we realize now, is it sustainable in the future? Surpluses from operating activities are used to repay loans. Eventually, we need to repay them. We need to take advantage of new investment opportunities and pay dividends, right? We need profits, at least for a for-profit company. We need some profits eventually to pay dividends. Investors paid to purchase shares to invest in the company. They want eventually some form of payout. Investing activities, cash flows from investing activities show if the company is maintaining its existing capacity, if new investments increases the potential of operating cash flows in the future, or if the company's long-term productive assets are being sold, divesting, I mentioned this earlier, and then converted into cash to pay losses in operating activity. This would be bad. What type of assets are being purchased? How do new amounts invested in PPE compare to existing? Large companies, multinational companies, have a sustained amount of investments in PPE, right? So when you think, oh, I'm buying a building, I'm buying a piece of land. Personally, me and you, if we were to do that, we don't do that every year. We don't have millions of dollars, right? We purchase one home, we hold it for a decade or so, right? Or more. And then we sell it and we maybe retire and downsize, whatever, right? But large companies have a sustained amount. They'll purchase regularly like 10 million a year in buildings and land, right? They'll sell some, they'll buy some. It's a whole business. So we want to see, is that sustained? Is it going down? Are they investing more or less? In what areas? Like technologies or research and development. Are existing assets being disposed of, reducing the potential of cash flows in the future? What if I sold all my losing assets? So I have, you know, I'm a manufacturer of shoes and hats. My hat business is doing really well, but my shoe business is not doing well. So overall, I'm doing okay, but not great. And I decided to sell my losing business, my shoe business. I'm getting rid of it. So I'm divesting from the shoe business and focusing on my profitable hat business, right? Well, that's going to change my future cash flows in a good way. Financing activities show any changes that took place in the firm's capital structure. Why? Because financing comes from two places. It comes from either liabilities through the issuance of bonds or debt or mortgages, and then equity, which is shares, right? They work differently. Liabilities are risky, right? Because you have to pay the interest back at a fixed rate. And they normally have some guarantees where if you don't pay, they can call the loan, create a cash flow crisis. They could take possession of your assets. Like if you've guaranteed your building, they could take the building and sell it to pay the loan that you didn't, to repay the loan that you didn't pay. The cool thing is that the interest is deductible for tax purposes, which dividends are not. Where equity, you only pay dividends if you're profitable. There's no obligation to pay them, and the dividend amount is determined by the board of directors that is nominated and elected by the shareholders. So we call this mix between debt and equity financial leverage. If I have a lot of debt, I am very highly financially leveraged. If I have low debt, I'm not very financially leveraged. And then I have more maneuverability, although I'm not benefiting from the deductible interest. I'm paying higher taxes because I don't have, I'm not deducting interest. And if I have a lot of equity and no debt, I've diluted the ownership. That means there's more owners. So normally the owners now don't want more owners. They want healthy level of debt, deduct the interest, and maintain the ownership for them for their benefit of, and they get a fuller share of the dividends. The objective is to determine if there will be increased demand for future cash in the interest. The more interest I have to pay, the riskier it becomes, the more I'm financially leveraged. And then finally, from a finance perspective, there's this term called free cash flow, okay? Free cash flow is a non-GAAP measure of analysis used by many companies and financial analysts to indicate this discretionary cash available for new investments, paying dividends, retiring debt, improving liquidity, purchasing shares, whatever, right? It's the cash. So free cash flow is calculated as operating cash flows, okay, which is the operating cash flow. So it's this part. So it'd be the 90,600 in our example. The 90,600 minus the average sustained capital expenditures. Okay, so it would be the average of investing activities, right? So we say, okay, for large companies, how much do I need to re-put in property, plant and equipment, PPE, or tangible capital assets, or research and development as well, right? What are the, and that's because I'm excluding depreciation, okay? But if I buy over a really long period of time, if I invest in tangible capital assets, my depreciation will be equal to my investments, like over a really long period of time. Because if everything gets amortized over 10 years, and over 10 years I've been investing in the same tangible capital assets, my depreciation expense, which is non-cash item, will be equal to my average investments. So we say that it's free cash flow is operating activities minus the average investments in tangible capital assets. Here, it would be really bad because I have 275, but it's an average. I'm assuming for this Eastern Window Products Limited, they are growing because they've contracted a debt to help pay for the investments. So I would think it's not, but it would be something like this. So say the average is $70,000 a year. So my free cash flow would be 20,600. And it's this, we want to see this being positive. And then you say, okay, well, is 20,000 good or bad? Well, I say, well, it depends. Is it better than last year? And is it better than the competitors, right? So when we do financial statement analysis, it's always longitudinally through time or compared to an industry, a competitor. It's a benchmark, okay? So the 20,000, well, it depends, right? But from here, we're able to start an analysis. And this 20,000 can be used to retire debt, pay dividends, repurchase shares, or just improve the overall liquidity for taking advantage of new opportunities as they arrive. Companies with significant free cash flow, okay, have a strong degree of financial flexibility. Whereas if you're highly financially leveraged, which we had covered in the previous slide, that is kind of the opposite of financial flexibility. Companies that have financial flexibility can take advantage of new opportunities or cope well during poor economic times without jeopardizing current operations. Because as soon as you get to no cash and you have suppliers to pay or bank loans, it's really difficult because you say, yeah, I'm going to be profitable next year. I just need to get over this economic, downturn in the economy. The banks and the suppliers are like, nope, we're done. We're now, if you want to buy from us, suppliers, you got to pay cash. And the lender's like, we're calling your loan. We're not dealing with this. So as soon as you get to zero, it becomes really challenging. And so profitable companies have still gone bankrupt or insolvent, even if they're profitable, because they didn't have any more cash. So having the cash is really important. So that covers it for today. Let me know if you have any questions. It was a lighter presentation compared to the heavier ones on leases, income taxes, and pensions. So that's great.